Wealthy and Wise is your guide to value investing, powered by Teaminvest.
Welcome to this week's edition of Wealthy and Wise. Well, as one expert on AusBiz put it, Anthropic's IPO filing is one of the most important AI market developments of the year. So Anthropic has rapidly evolved from being viewed as a distant challenger to OpenAI into one of the strongest enterprise AI platforms, particularly in coding, software development, and agentic AI. It's become one of the fastest growing software companies in history, and the IPO will give investors one of the first pure play opportunities to gain exposure to the generative AI application layer. So today on Wealthy and Wise, we'll take a step back to consider what you're getting as an investor when you participate in an IPO. We'll consider where your money is actually going, what the difference is between primary and secondary markets, and what capital flow can tell you about value creation, dilution, liquidity, and perhaps even broader market cycles. We'll also go a bit deeper into the expected Anthropic, OpenAI, and SpaceX listings to try to determine what they may mean for passive and active investors and, importantly, the state of market sentiment. So first, let's add some value. So let's talk about IPOs and the difference between primary and secondary issuances and why that matters for investors at the macro and micro level. And joining me to do so is Andrew Coleman from Teaminvest. Hey, Andrew, nice to see you again this week. So we hear terms like IPO, placements, rights issues all the time. So maybe we could just start by explaining in simple terms, I suppose, what the difference is between primary and secondary markets.
Yeah, so really simply, a primary market is when new shares are created by the company, sold down, either to broaden its ownership, that's an initial public offering, IPO, or a placement to raise capital, or a rights issue to raise capital. And the secondary market is what most viewers would be participating in, which is trading on a listed exchange. So in that case, no new share is being created. It's simply the owner of the share is changing hands. And that's, of course, a very big different use of capital. Because if you think about it, a primary issuance is taking money from investors and putting it in the hands of the company to do something with, either to spend on working capital or capital expenditure or a new investment, or to pay out the owners to go and have a nice new yacht. And in the case of a secondary market, it's between traders in the market. So the money in a secondary market never leaves the market. The money stays within the system. In a primary issuance, the money goes out of the market into the hands of the company to be spent on something other than future share trading.
Right, so all types of shares or transactions fall into one of those two buckets. So why should a value investor care where the cash goes, if I can put it so crudely?
Yeah, well, I think Charlie Munger said it so well. He said, show me the incentive and I'll show you the outcome. So in the case of an IPO, effectively what the company is saying is it's saying that your money is worth more than our shares. And so what we'd like is to exchange some of our shares for your capital, which we then hope to put to use and get enough of a return by using that money that it pays off the cost of doing an IPO or a placement, which of course is expensive, and the fact that they're diluting themselves by issuing new shares. In the case of a secondary market, it's the same thing, except it's not the company telling you that your money is worth more than their shares. It's some other investor telling you that your money is worth more than their shares. And of course, those two have very different information asymmetries. A secondary market trader, someone else in the market, another investor, may have a different view on the company or a need for the money. That means, they're making a trade not because they think the company is worth too much, but simply because they'd like the cash for other purposes. On the other hand, when a company is issuing new shares, it's always, by definition, because they think your cash is worth more to them right now than their ownership. And that means that there are big risks associated, or bigger risks associated with an IPO or a primary markets issuance than there is with secondary trading for the average investor.
But value is created, right, by a productive use of capital.
Well, value for the economy is created by a productive use of capital, absolutely. I mean, if you think what's the principal purpose of a market from an economic point of view, there's two. The first is to enable companies to raise capital to do things with it. That is the primary market side. And then secondly, it's to enable people to transact to share different parts of a company so that, you know, they can switch between investments in ways that they see fit. So from that point of view, IPOs and primary market issuances are good for the economy as a whole because it's money going into things that are hopefully productive. But there's a key word there that's doing a lot of lifting, and that's the word hopefully, in that term hopefully productive, because of course, if a company raises money and spends that wisely, that's good for the economy. On the other hand, if a company raises money and spends it poorly, blows it up, then of course that hasn't done anything for the economy at all.
And so when we are talking about capital raising, so not buying a BHP share, to use a crude example from me, but BHP decides to issue new shares because they want to raise capital, they could do so to fund growth, they could fund acquisition, they could fund expansion. So it sounds to me on the surface like you're not that keen on IPOs because there's not the history to prove what those shares are worth. How do you feel about capital raises?
Yeah, I think all of them go in the same category, and it's not so much just the lack of data, though obviously all IPOs have to some extent a lack of data, but they all have the same two problems from a value investor's point of view. The first is that almost always when a primary issuance occurs for a company that's already been listed, it has to occur at a discount to the current market price in order to entice people to participate. As a result, effectively, to an investor, it's a company diluting you twice. They're first diluting your share of their business because they're issuing more shares, so that hurts. But then secondly, they're doing that at a value destructive price. So you're getting whacked twice. Now, if they do good uses, or if they put that money to good use, the gains in the future may make up for the pain in the short term. So I'm not anti them in principle, but you want to be very certain that the use of that capital is going to pay back you as an investor, not only for that extra dilution, because there's more shares, but the cost of that dilution for the discount. Now, the second point, though, that I really want to touch on, because I think it's really critical, is that information asymmetry. When you trade in the market, you trade, the secondary market, you trade against other people who have, one hopes, assuming, you know, everyone has abided by their continuous disclosure obligations, exactly the same information as you. In other words, it's a level playing field. But when you participate in primary issuance, you are, by definition, playing in a game of information asymmetry. The company knows more than you, its insiders know more than you, and because they're selling a part of their business at a discount to what they claim it's worth, because that's how all IPOs or primary issuances work, you know, we're worth this, here's a discount to entice you to play, you have to ask, is that discount real, or is that just the lovely salesman's game of let me talk it up so that I can put the risk in your hands rather than my own?
And all of this is tied to liquidity in the broader market as well, right? Because if you've got the secondary market essentially recycling that capital, the primary market is absorbing that capital. How does that work in layman's terms?
Yeah, well, they both have very different impacts on liquidity. You're 100% right. So in the secondary market, the shares will trade back and forth. You know, if you're a long-term investor, infrequently. If you're a short-term investor, maybe 5-10 times on the same day if you're a day trader. So the liquidity, the volume of shares being traded, is unaffected in the secondary market by any one individual. You know, you're trading to me, I'm trading to you, that share's still in circulation, the dollars are still in circulation. And you get a bit of a multiplier effect. In other words, for every dollar in the secondary market, it changes hands multiple times over the course of the year. In the case of a primary market, though, as you put it so nicely, it's a sink for liquidity. It sucks up liquidity because people who would have been prepared to trade with each other are instead saying, well, rather than trading with Nadine, I'll give my money to the company in exchange for a new share. And then by definition, there's less cash available for Nadine and Andrew to trade back and forth because a bunch of the cash that was being traded isn't in either of our hands anymore. So from that point of view, they have very different impacts on liquidity. Now, normally that impact is relatively muted because the size of an issuance tends to be relatively low, both relative to the scale of the company itself. You know, a traditional placement is up to 15%, so it's not a big amount. And secondly, tends to be done over quite a long period, infrequently, and so the effect on the market is muted. Though I think, if I may segue into a little bit of where I think you want to go in the next section, we now have the 3 largest potential IPOs in history all wanting to come due at the same time. Now that is going to have a material impact on market liquidity, if you ask me. We will find out if I'm right in some months' time.
Well, I think you have set us up quite nicely. So that's adding value. Next, let's go head to head. Well, history suggests that some of the biggest IPOs arrive at moments of peak optimisms. Investors are excited, valuations are elevated, and capital is abundant. But could large IPOs be more than a symptom of market enthusiasm? Could they actually create conditions that make markets more vulnerable? Or are they symptomatic of a new and exciting and world-changing thematic, as which we might be seeing with some of the world's most anticipated listings approaching, including names such as SpaceX, OpenAI, and Anthropic? Should these mega IPOs excite investors or make them a little cautious? Andrew Coleman from Teaminvest is still here with me for some more perspective on these mega IPOs coming. Welcome, David Tuckwell from ETF Shares. David, hi. Andrew, welcome back. So you can just give us your take, top down, on where we sit in history with these eye-watering blockbuster IPOs coming to market.
Sure thing. So you've got SpaceX, Anthropic, OpenAI, all coming within the next 12 months. They're all being driven to market by the exact same thing, which is the amount of capital it takes to run and compete in the generative AI space. Now, usually when you've got a really good business, you don't want to go public with it, because why would you give away highly valuable shares to any old random that can buy them on exchange? But what's starting to happen is the cost curve is moving higher and higher and higher for these generative AI models, and they need, the founders, the early shareholders, they need to start sharing the risk. Playing chaser in all this is Google. Google has all the best people in AI, not all, but almost all, and Google has the most money. It's now the most profitable company in the world. So if you're at OpenAI, if you're at Anthropic, if you're at Elon Musk's little AI joint, which is merged with SpaceX, XAI, you're running a bit scared of Google, and they're all running to public markets now, partly for an exit, but also partly because they need more money to compete.
That is probably one of the best explanations that I've ever heard about what's going on right now. So it's no coincidence. It's no, keeping up with the crowd, jumping on the train that you're seeing all these guys come to market. So, right now.
Yeah, well, I think you've summed it up perfectly. They need capital, and they're struggling to raise the amount of money that they need to raise because the sums are getting larger and larger, and debt markets, private capital markets, are tapping out. And as a result, rather than cheap debt, which we've had for the last few years, they're now starting to look for expensive equity. So I think you've nailed it, right on the head. I think the other thing is it's very hard always if I take a step back from sort of an economic history lens, to say causation rather than correlation, because you never really know exactly what was a trigger or what was a cause, but you can say things are correlated, they happen together. And if you look at the history of very large IPOs, I don't mean small companies, I mean major global IPOs like these will certainly be, they have, with almost 100% regularity, occurred right at, as you said at the start, right at the peak and just before a period of significant underperformance in that specific asset class. And the reason for that is actually, I think, to the point we were talking about before, quite simple. It's two things. Firstly, euphoria. It's easy to get away a very big IPO when everyone is greedy. It's a hell of a lot harder to get a big IPO away when everyone is fearful and thinking, they want very quick returns on their capital. So there's a correlation element of timing in the market. But secondly, these very large IPOs suck up a lot of primary issuance out of the market and a lot of liquidity out of the market right at the peak, which means that investors who may have had money to trade another share and keep its valuation inflated suddenly find themselves with, on paper, something, but no cash to transact with each other. And as a result, the market is made up of simply buyers and sellers matching. If you take money out of the buy column and you keep the sell column the same size, prices go in one direction. And history is littered, and we can talk about those examples, with big IPOs coming just before the crash in their market. I'm not sure whether this will be the case with AI this time, but correlation isn't its friend.
What do you think?
A crash? I'm not sure there's going to be a crash. But what I do think is absolutely true is that they're looking for equity funding because they don't want to tap the debt market, and I certainly wouldn't want to either. A big source of the capital raise here is going to be coming from index funds, especially the NASDAQ 100, and we've seen the rules change on that index to accompany, to speed up the acceptance of these companies. So a crash, I don't know, it's definitely true that has been the case historically. Will it be the case again? It's always so hard to say, isn't it? But yes, the cost curve moving higher and higher is absolutely spooking.
So you've described this as potentially more about ETF and index mechanics than fundamentals. So what do you actually think is driving the price action in names like, like Rocket Lab and all of these other ones that are out there?
Yeah, so index funds and ETFs are becoming more and more important and popular. As they do, they become more and more powerful in setting companies' share prices. So what has the market so excited about these space stocks? You mentioned two of them, SpaceX is another one, is that they're not yet included in these big, powerful indexes and ETFs. As they become included, and it's looking likely that those names you mentioned in SpaceX will be within the coming months, these ETFs and these index funds become forced buyers of their stock at whatever the prevailing market price on the rebalance day happens to be. So if you're a shareholder of a Planet Labs or a Rocket Lab or a SpaceX, that's really exciting for you. You've got buying coming out of the pipe at any price. That does wonders for your share price and for the value of your asset.
Yeah, right.
And isn't it a little bit of a perverse thing here, isn't it, where we have for a very long time said the poorest people, those with the least knowledge, should participate in passive index funds because that way they get a nice broad slice of the market and they don't have to worry about making decisions. And it's their safe, limited capital that is going to be a buyer at any price into some of the most speculative companies in history. Do we think that's a problem for society yet, or are we still happy with it? I don't know.
Well, are ETF investors exactly as described?
I don't think they're naive. Every form of investing has its weaknesses. The alternative has been active funds management, and we're many decades into that experiment now, and I think the results are in. They charge too high a fee and they don't deliver. The alternative, ETFs, it's not perfect either by any stretch of the imagination, but at the same time, I think it is an improvement on where we have been historically.
Okay, so that's a little bit of a mini head-to-head on active investing and ETFs in general. But when we're thinking about the impact of these, I mean, the amounts are eye-watering. We're talking anywhere between $1.75 trillion and $2 trillion for SpaceX. Can anybody really tell us exactly where that comes from?
Where that comes from? Yep. So we know about 25%, just roughly a quarter, almost bang on a quarter in fact, of SpaceX initial float is going to be gobbled up by NASDAQ 100 index funds. Once you then pile on active managers that follow the benchmark very closely and other indexed money, it's going to be about half of it. So that's where it's all going to come from, and that's quite impressive, isn't it? But yes, other things within the index are going to need to be sold down in order to generate the cash with which you buy those SpaceX shares. So yeah, we do have a pretty idea where it's going to come from. It's going to come from indexed money.
So this is a liquidity moment for markets in your view?
Yeah, I mean, we were talking about that a bit before, but remember the largest ever IPO in history before these three was Saudi Aramco back in 2019, which raised $25 billion and triggered about a 4 or 5 year decline globally in energy stocks. Effectively, liquidity was sucked up and there was not a lot left to play for the other energy stocks. The second largest in history in real terms, adjusted for inflation, was NTT Docomo, which listed on the Tokyo Exchange back in 1998, for anyone who remembers, and triggered a major collapse in Asian and emerging markets, or at least was correlated with a major collapse in Asian and emerging markets. And that raised $18.4 billion. And the third largest was, real terms, was Visa of $17.9 billion, who timed their IPO to perfection in 2008. And I think there was a little thing that happened just after that, some financial crisis, sucking up financial stocks. And then, of course, the fourth largest was Enel, E-N-E-L, which was at $16.6 billion in 1999 and resulted in about a 15-year decline in the Italian bourse. So from that point of view, the track record of very large IPOs correlates, whether that's because they timed the market to perfection or because it sucked up liquidity. You'd have to do more research to prove each, with material index underperformance in that index going forward. Now, regardless of that, the even scarier thing, and you've just raised, is the scale of these. As we've just said there, that the largest in history was Saudi Aramco at $25 billion. SpaceX is looking to raise on the primary market $75 billion, 3 times Aramco. Anthropic's announcement today says they want to raise about the same, just a bit under, but pretty close to the same as SpaceX, and OpenAI is expected to do around 40 billion. So overall, that's somewhere north of 150, maybe close to 200 billion in IPO issuance in a 12-month period. That's 8 times at 200, 6 times at 150, the largest ever IPO in history, and we're going to do it all in one go. Sounds to me like we're about to perhaps sleepwalk into a problem. Now, the good news as a value investor to that point, if I can say, of course, is you don't have to play. The beautiful thing, and there are problems with being active, I'm not defending it, but the beautiful thing about being an active value investor, like we are at Teaminvest, is you can sit out when markets are being greedy. You know, Buffett's wonderful quote of be fearful when others are greedy and greedy when others are fearful, and maybe buy the things that are going to get sold down from the index to make way for SpaceX. So, you know, from our point of view, that's not a bad thing as a value investor. Perhaps as a market, it's a bad thing. Perhaps as an economy, it's a terrifying thing. For a value investor, it's just business as usual.
Well, David, that's a question, isn't it? Those mega IPOs, I know that you say that the index funds will be forced to participate, but could it also act as a liquidity magnet from other thematic ETFs?
It absolutely could. It'll depend very heavily on the index. Some indexes pile on quicker than others. So a famous one there is the S&P 500. That piles on very slowly. You've got to have been profitable and been profitable for 6 months before they get stuck in. And yeah, I don't know how long it's going to be till your SpaceXs of the world actually start to turn a profit. It could be a very long time by the looks of things. But yeah, they absolutely could. Coming back to the question of causation versus causation, I don't dispute that a lot of the IPOs in the past have occurred at the top of the market. And if you think of your perspective as a shareholder in these private companies going public, the last thing you want to do is sell something for $1 today that you could sell for $2 tomorrow. So it would absolutely make sense that you're trying to time that at, you know, as a rational capitalist at the absolute highest price possible. But yeah, I don't know, with AI, I'm just so impressed with how far it's come so quickly. And if, you know, things keep progressing the way they have over the past 5 years, for the next 5 to 10, I can continue to see a very long runway for growth for these companies. And I don't know, it's equally possible that these shareholders are exiting too soon, but they possibly know something that I don't.
Yeah, time will tell. So your final, I guess, thesis is that the market may not be able to handle these big mega cap IPOs in such a short period of time. So you would just sit out and watch to see where it all ends up?
Yeah, I think there's the 2 points there. Firstly, the information asymmetry one, and you've just hit the nail on the head. Why do they want our money instead of their shares? Well, clearly, for whatever reason, maybe it's future growth, maybe it's because they know something's coming, who knows? But clearly they think your dollars right now are worth more than their shares. And for someone like Elon Musk to be saying that, he says lots of things, but him to be saying that, at some point you may want to listen, I would think. The second one is that historically big IPOs correlate with big downturns. Boeing in 62, just before the crash, AT&T in 73, just before the 1973 crash, BP and Conrail in 87, just before Black Monday, 89, the UAL leveraged buyout and IPO, followed by the mini crash of October, AT&T Wireless IPO, followed immediately by the dot-com crash, 08 Visa, Aramco, we just gave the other examples. So the pattern's not deterministic, but it's certainly there's a lot of correlation that says the market struggles to absorb big primary issuances. So from that point of view as a value investor, long-term investor, you can say, I don't need to be in anything now. These may be wonderful companies, but maybe the best thing to do is to sit out and wait for them to be available at a better price. And perhaps you might also say, given that none of the three have ever made a profit, they may not even be wonderful companies. They may be wonderful promises of a company, but we'll find out in time.
Well,
but
yeah.
if I can make one defense of ETFs here, because usually I don't make defense of ETFs and things, but
I didn't even know this.
I think you're right. I mean, I think there's two things. Number one, you're buying what it says on the tin, right? So don't blame an ETF or an index for doing what the ETF or the index says it's going to do. You know, if you don't like that, own a different index or ETF, because not all indexes and ETFs are constructed the same way. You know, you mentioned the S&P 500, but you know, the Dow, for example, is an equal weight. It's not a market cap weight, and it's an equal weight of companies chosen by journalists, the Wall Street financial journalists, rather than anything to do with market size. So you can participate in index funds that won't catch you up in these primary IPOs if you're worried about them. You just need to know which fund you're in or which index you're in and choose accordingly.
Yeah, but on the other hand, you could get in at the ground level via some of these index funds. I mean, have you been fielding lots of questions about how and when investors can start getting exposure?
Yeah, so our ETFs and our indexes don't go in on IPOs.
Yeah.
We're a little bit wary of them because they do have a bit of a mixed track record. So we haven't personally been. That might be a question for some of our competitors, shall we say, that might be jumping in on these a little bit quicker. But yes, I also do take the point that it's not deterministic. I mean, a lot of IPOs haven't worked out historically, but those space stocks that we mentioned, there might be an example the other way. So Rocket Labs, Planet Labs, I think they both IPO'd at about $10 each. About 4 or 5 years ago as part of the SPAC group during COVID. Their share prices have gone up 5 or 7 times or so since that IPO. So it's not all one-sided, the history of this. Yeah.
David Tuckwell, thank you so much for coming in.
Thanks a lot.
And Andrew Coleman as well from Teaminvest. You'll have to make your own decisions. Stay with us. We'll answer a viewer question next. Now to You Asked. If you would like to ask the team a question, you can email us at wealthy@ausbiz.com.au. And I love that we get these questions based on the previous episode. This week, Timothy has written in saying, you said, presumably you, Andrew, last week that you sold MinRes as its debt pile grew and it changed its business model. But now it's reducing debt. Would you consider it again, given the improving balance sheet? That's from Timothy. What do you say?
I think in general the answer would be yes, but there was more than just the debt, as Timothy's picked up, that meant, I mean, the debt was the first trigger, but it's more than just debt as to why Min isn't of interest to us and our members anymore. Whilst its debt burden is very high and they can pay that down, it's also that the change of business model to being a commodity producer rather than a mining services company has destroyed the stability of earnings of the business.
Yeah, I think
so it
you
would
did
fail.
mention that, yeah.
So it would fail that hurdle for us now, and return on equity and return on capital that comes with it, because it's clearly much more capital intensive. So that's the quantitative. And then on the qualitative point of view, I can't be certain because we haven't had that discussion, but I'm guessing the antics, potentially criminal, some of the antics, though that's not for me to decide, of the board and management at Min over the last decade is probably also would have turned our members off on the question of trustworthiness and competence, and partner mentality is probably the best word of the management team at Min. So look, I think it's a wonderful company in many ways, but when there is low stability of earnings, too high debt, and any question that a shareholder needs to ask about whether management and board are aligned with your interests or just their own, it immediately goes into the too hard basket. So I don't see a time where Min will come back on our radar, but it may. You know, if they perform and they pay their debt down and their earning stability increases and they solve their governance questions, it could be a useful look.
All right. Andrew Coleman, Teaminvest, thanks as always. I thought that was a great episode. Hope we've given you some food for thought on IPOs in general, and particularly as you will continue to see these headlines coming out about these blockbuster IPOs due to hit the market in the US this year. Again, you can send us a question, wealthy@ausbiz.com.au. Thanks for watching Wealthy and Wise. We'll see you next week.
Wealthy and Wise is your guide to value investing, powered by Teaminvest.